Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the power of credit derivatives, how they shape the financial system. Credit derivatives, a comprehensive guide. Credit derivatives play a significant role in modern finance. They help institutions manage risks and create opportunities for investors. By shifting credit risk, they enable better portfolio management and provide unique ways to protect against defaults. But how do they actually work? Let's break it down. What are credit derivatives? Credit derivatives are financial contracts that transfer the risk of a borrower defaulting on a loan or bond. They allow one party to shift credit risk to another in exchange for a fee. This makes them tools for managing financial exposure without owning the underlying asset. At the core, they're driven by a simple idea. If you're worried about a loan default, someone else may be willing to take that risk, for a price. For investors, these products also offer ways to hedge portfolios or speculate on creditworthiness. Types of credit derivatives. There's no one-size-fits-all when it comes to credit derivatives. They come in various forms, tailored to different needs. Credit default swaps, CDs, by far the most common type. CDs are like insurance on loans or bonds. If a borrower defaults, the protection buyer gets compensation from the seller. Total return swaps. These allow an investor to exchange all returns from a credit asset for a fixed rate. This includes interest payments and any capital gains or losses. Credit-linked notes, CLNs. CLNs are bonds that combine regular interest payments with credit protection. Investors take on credit risk in exchange for higher yields. Collateralized debt obligations, CDOs. CDOs pool various loans and sell slices of risk to investors. Each slice, or tranche, has its own risk and reward characteristics. How credit derivatives work. A credit derivative transaction typically involves two parties, the buyer and the seller. Let's say you're a bank holding corporate bonds. You might worry about a company defaulting. To hedge this risk, you pay a fee to a counterparty, the seller, in a CD's contract. If the company defaults, the seller compensates you for losses. If not, the seller keeps the fee, and there's no further obligation. The mechanics boil down to transferring risk. Instruments like CDs allow banks and funds to offload risk while others, like hedge funds, take it on in hopes of earning higher returns. The importance of credit derivatives in risk management. Managing risk is at the heart of why credit derivatives exist. They give institutions and investors tools to handle credit exposure without selling off assets or making drastic changes to portfolios. Hedging against default risk. One of the biggest fears for lenders is default. Credit derivatives act like a safety net. If a borrower fails to pay, a CDs or similar product can replace the lost income. Hedging tools like these are especially critical during economic downturns when default risks are high. Enhancing portfolio returns. Credit derivatives aren't just about protection. Many investors use them to boost returns. By selling credit protection, you effectively take on some risk, but you earn income from the fees. When carefully managed, this strategy can make portfolios more lucrative. Regulatory considerations. Credit derivatives have faced increasing regulation, particularly after the 2008 financial crisis. Reforms aim to increase transparency and reduce systemic risk. For example, central clearinghouses now handle many trades, reducing counterparty risk. Still, regulatory requirements continue to evolve. Stricter reporting and capital requirements aim to make the market safer but also increase costs for participants. Challenges and risks associated with credit derivatives. While credit derivatives offer benefits, they come with their own set of challenges. Mismanagement or misuse of these products can lead to serious financial consequences. Counterparty risk. Every credit derivative deal relies on the counterparties honoring their commitments. If the seller of protection defaults, the buyer is left exposed to the original risk. This was a major issue during the 2008 crisis when institutions like AIG couldn't meet their obligations. Market volatility and liquidity issues. Credit derivative prices are sensitive to market conditions. When markets are volatile, liquidity can dry up. This makes buying or selling these products much harder. For investors relying on them for hedging, illiquidity can turn into a major problem at the worst possible time. Future trends in credit derivatives. The credit derivatives market isn't static. It evolves to meet new challenges, driven by technology, regulation, and market demands. Technological innovations in credit derivatives. Advancements like blockchain and artificial intelligence are reshaping finance, and credit derivatives are no exception. Blockchain could revolutionize trade settlement, making processes faster, cheaper, and more transparent. AI, on the other hand, is providing smarter risk assessments, helping both buyers and sellers make informed decisions. Evolving market practices. Market participants are likely to adapt further, optimizing how they use credit derivatives. New strategies may arise as participants look for innovative ways to manage risk or find alpha. Shifts in economic conditions and interest rates will also influence market behavior. Conclusion. Credit derivatives are essential tools in today's financial system. They balance risk and return while giving institutions and investors flexibility in managing exposure. From hedging against default to enhancing portfolios, these instruments offer unmatched versatility. However, they're not without pitfalls. Counterparty risk, market swings, and regulatory hurdles demand careful attention. As technology advances, the credit derivatives market is also poised to change, offering new opportunities and challenges. Understanding credit derivatives is more important than ever in navigating the complex world of modern finance. Whether you use them for risk management or return generation, they remain key players in the financial toolbox. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.